Okay, so guys, welcome back. We're going to work in number 5. Still, you go to the information, the question, and we continue from where we stopped. Okay, so the next item is the payables bit. So the payables of Paulson include 6,000 payable to Sabrina in respect to inventory purchases. Receivables of Sabrina include 10,000 due from Paulson. The parent company sent a check for 4,000 to its subsidiary. Okay, and that should explain the difference. That the parent said that I paid the guy. Okay, parent saying that I paid you. That's why his figure is less by 4,000. And the subsidiary is saying I haven't received the money yet. Okay, but that's not an issue. The issue is that this is how we go about it. Okay, what we do is for intercompany balances. This is still working number 4, but probably part B. Okay, still intercompany, but these are balances, company balances. Okay. So for intercompany balances, what we do is you identify that you have a payable. How much? So 6,000. You put the figure 6,000. In this case, 6. Yeah, you ignore zeros. Then you identify that you have a receivable. Remember, as a group, what you have is actually mine. If it's payables in parents, it's actually payables in subsidiary. Here we're saying we are 1. Okay. What you have is what I have. Okay, so you have a 10 here. So how we go about this is you're supposed to eliminate these transactions. So you cannot demand me and I can demand you. So it was an error. So in doing that, we remove. Now in removing, you're saying for payables, it's a liability. So the only way you can remove it is when you debit. So you debit payables. For receivables, it's an asset. The only way you can remove it is by crediting it. So you credit it. Okay, you credit it. So in crediting, as you can see, the amounts don't balance. Okay, so there's a 4 somewhere. Okay, so there's a 4 somewhere that's supposed to fill the debit side. And this is what we call the bank. Okay, the bank balance, the money. So we assume that you actually received it. So you debit it. Okay. So these are the entries you do. You just come, remove the payable that they're saying, remove it. Receivable, remove it. Bring the balancing figure. The balancing figure must go to the bank account. That's how we remove this. That's a shortcut, just to tell you. Now we're good to go. So we go to the next item, which is let's say that what else? So we're done with all information, I think. Okay. And the pay account group, yes, the group account, the group working, then do the NCI. So number 5, we're saying group retained. Yes, for group retained earnings, you're aware that you bring everything. You bring, actually, before I do that, I was skipping. The other intercompany is working number 4, part B. Still, okay, let me call it part C. The one of preference shares. Relative preference shares. Okay, this is another an intercompany balance. Okay, that you're saying in no way you and I cannot do what? Cannot demand each other. So what we do is you remove this. Remember, this is an equity account, so it has credit. Okay, then having credit, you have to debit it. So we debit cumulative preference account. With the 10,000 that we acquired, 10,000. So it is 10. Okay, and then credit investment. Okay, investment in Sabrina. We're saying that we had an investment in Sabrina in terms of equity shares, but they're saying that's not an investment. You cannot be claiming 10% interest every time. You can't be saying that you know, something like that. So it's not supposed to be there. In short, you can't demand me, I can't demand you, because we are one, right? Just like you would see with dividends. If the subsidiary pays dividends, the parent, in consolidation, we remove the dividend because you cannot pay to yourself. Okay, we're saying you're just transferring money to another pocket. So these are the two entries. As you're going to see how we affect them, they usually affect the balance sheet items. Okay. Okay. Then, so for group retained earnings, the working number 5 I was talking about. So for group retained earnings, you just bring all of the parent. Yes, all of the post. Okay. This one is from the try balance. You can go and pick the figures. Try balance. Okay. How much? So the here up is the retained earnings 65. Okay, you can all see it also. Retained earnings 65. Okay. Okay, so you put 65. Okay, so 65,000. The whole of it, just put it in 65. And then you bring share of post acquisition. Okay, post acquisition profits. Okay, of the subsidiary. Okay, so that's why we go to the working number 2. Working number 2. And we see this change here in the retained earnings, this change here between is what we call the post acquisition. Okay, from the acquisition date till now, what we made was 15. So of the 15, as the parent only have 80%. So you bring and you say 80% of 15, which is the post acquisition. Okay, so it's 80%. So you have it as 12. Then what else? So now you're done with the share. So you move line by line. You see if there's any transaction that you made in between that could have affected your group retained earnings. Okay, so if I move from up, so here saying you're done with this part, only this affected it. Then you go to, when you go below, under group retained earnings, under goodwill computation, impairment would have, but there's no impairment. It was a 0, so there's nothing. Then you go to working number 4, intercompany transactions. You have unrealized profit, and as you can see, your group retained earnings was affected by a 3 and it's a debit. So we call it unrealized profit. So you come under group retained earnings, and you say provision for unrealized profit. These are 3, okay, but it's a negative because it's a debit. Okay, I rounded off. For those who didn't round off, it's I think 3.2. Okay, so we have a 3. Then so you're done with that one. This one also is always communicate where the thing is coming from, since it's from working number 4. But here I think. Okay, then now we continue. Come back to working number 4 and move downwards. So we had finished this one. So we move downwards. We have another intercompany, but retaining earnings not affected. Then cumulative, nothing. And you're good to go. So you're done with all the information. Then you add. What do you have as your retained earnings? You have a 74. So this is your total. Total group retained earnings. Then lastly, we have had a movement, I think, in a group revaluation reserve. Okay. You can go and check on its working number 2. Okay. Yeah, group revaluation reserve, this 2 here, this -5. It's a movement. So if it's a movement, you come and you say group revaluation reserve, you bring all for the parent, all parent, this guy's person from the trial balance. So can you check it? Trial balance. Structure general reserves. It is 68 for the parent. $68. Okay, it's actually general reserve, not revaluation. Then you say share or our share post acquisition. What can I call it? In this case, it was a loss. So the post acquisition movement. What is the share of movement? Post acquisition what? Post acquisition reserve. Doesn't sound right. Post acquisition loss because it was a loss. Okay. Now we want to take our share, okay, which is 80% of the -5 or the 5, which is negative still, it's a loss. 5 of 4, but it's negative, so bring the negative. Okay, then nothing else was affecting it, so you just add. You have 64 as your what? As your total general reserve. Total general reserve. So you're done with all the reserves, then there's working number 7, which is the last. The non interest. We had a movement in preference shares, but as you saw, share premium doesn't have a movement. Okay, so if it has no movement, you don't do anything. Okay? So now NCI computation. The NCI computation, you just bring the fair value at acquisition date. Okay, this one is the way it is in the working number 3. Is the way you bring it. Okay. So what was it in working number 3? Yeah, goodwill. It was 34, as you can see. Okay, the way it is 34. So you come and you say at 34. Okay, then you begin share of post acquisition profits of the subsidiary. Okay. So it is 20% of the 15, if you remember. Okay, so this will be what? I think it will be 3. Right here, 3. Then share of the general reserve movement. General reserve movement. Reserve movement. Okay. We saw that it was 1. Now we get the 1 and say negative. Moreover, now we get the 1 and saying it was 20% of the movement. The movement was -5 from working number 2. Okay. So it's 1. Okay. Then what else? I think from working number 2, you can go back and you check that everything is affected. Working number 2, you have seen. We saw general reserve and retained earnings. Okay, the 15 and the 5. Then goodwill, there's no impairment. Then intercompany, there's this one here, the annualized profit affecting the NCI. Okay, it's a debit, so it's a negative. So come and bring it. Annualized profit from working number 4. Okay. It was a 1 as we split it. So the way it is, the way we put it there. Then what else? It's a negative. Okay, so don't forget these small things like negatives. You will feel happy when you're from a number and you're sure you did it, but didn't really do what you wanted. Then so we're good to go. We don't have any other item affecting our NCI. So we add. So when you add, the total is 35. Okay, so you're done with the addition information. Now you consolidate. Okay. Now, how do you consolidate? In consolidation, after doing all these workings, you come to your already written statement that we agreed, the heading, the other page. Then you come and move line by line along the statement of financial position. Line by line, don't skip anything. Don't be so fast to run through. So the first line is the tangible non-current assets, 218 and 160. Just add them together. So I'll just use shortcuts when I'm writing them here. PPE. Okay. saying had 218 plus plus 160. Okay. Did you have any items affecting the PPE? Did you see anything like fair value adjustment or anything like that? I don't remember. I don't think I saw anything. So you add 218 plus 160. Okay. Then that's done. You move on. Next line. The next line says that investment in Sabrin. Now, if you see investment in Sabrin, it's 160. So you want to know, what did I do with this 160? Okay, what we did is this. That one, we have an intangible asset called goodwill. It's working number 3. He brought it the way it was. I don't remember the amount. I can just take it there to copy, just share. So the goodwill was 14 here. Okay, so it's 14. Then what else? Now this 14 is for the 150. Okay, out of the 160, 150 have gone with the 14. Now the 10 goes with this item here. This last adjustment they made. Where is it? The one with cumulative. Okay, this here. We are debiting cumulative with 10 and crediting investment with 10. So when you debit an investment, sorry, credit it, you're reducing it, you're removing it. So that's how the 10 also disappears. Okay. So we continue. Line by line. Okay. The next item is what? The next item is inventory. Allow me not to share this this question again, since you have it. So just be putting the figures, and you can correct me if I feel I'm going wrong. Eh? So for inventory, we have 111 plus 65. Inventory. Okay, and then for inventory, we also had another item affecting it. We saw this selling. So when we sold, there was 4. We're supposed to remove. Remember, we created inventory on that working number 4A. Number 4A. Okay, we can go there and check it out. Okay, working number 4. It's number 4A. I didn't say A, but it's A. Okay. Yes, Shakira, you can ask a question. It's funny. It's a credit.
What about now? What of the last part that shows impairment? It's like as if we have impairment in the question.
Yeah, and I explained. I will explain. No worries, but I will explain it. Let me explain it again. Okay, so for impairment, you guys, we said that back to our goodwill. Okay, this is goodwill. The statement was like say that an impairment review, okay, you know impairment review, IS 36, at their end shows that the value of goodwill has fallen to 19,500. Okay, it has fallen to. Now you fall if you're coming from up. You can't fall when you're coming from down. Okay, so the goodwill is 14. 14 is less than 19,800. So you can't say that it was impaired. And the reason is, if you're falling to 19,800, that is your recoverable amount. I already explained that. Let me show you again what I showed you. This part here, we say that there's an impairment if the recoverable amount, the 19,800, is less than the carrying amount. In this case, which is 14. Okay, and we're saying that's not true because 19.8 is greater than 14. So there's no impairment. Okay, so the impairment is 0, Shakira. All right, so let's continue. So inventory, we are done. Eh? So we're going to the next item. Thought Non-transactions like selling is in the company. I've not understood your question. I thought non-transactions like selling in the company. But that's where there's okay, I don't know what you mean, but these are the adjustments that we make under intercompany transactions. And the working number 4 for the working that we have in class. Okay, the intercompany transactions. You have actually sale of motor vehicles or non-current assets, sale of stock, normal stock, like it is in this case. You have things like intercompany balances, loans, all those are intercompany transactions. They don't happen or they don't occur. Okay, that's what I said. And that's why we're removing these figures, by the way, we're removing the -4. That's part. The idea is, okay, you're not supposed to sell to me. And if you go to the P&L consolidation, what you normally do is you go under sales, remove the 10, and then go under cost of sales, remove the 10. Okay, so the idea is removing it. Okay, but now that is P&L, it can't affect the asset account register. So I hope I've answered you. But what really matters is whenever there's I had gone off shortly, but I think it's the network. Then so we continue. The next item is okay. For those of the question, saying receivables, okay, 30 and 15. Okay, now for receivables, you also saw